Hello, and thank you for joining me for this AJ Bell Investcentre on the Road webinar, where I'll be talking through the FCA's platforms market study and what it means for financial advisors. Before I kick off, just a few admin notes. Delegates can ask questions at any time during the presentation in the questions box within the control panel on the right-hand side. These questions will only be seen by the moderator, and all questions will be answered via email once the presentation has concluded. Any technical problems should be reported in the questions box, and someone will endeavour to come back to you to fix those. An email will be sent out after the webinar has concluded to ask delegates to fill out an online feedback form. A CPD certificate and a copy of the session slides will be issued via email as well. In order to qualify for structured CPD time, the webinar must be watched in its entirety. A copy of the recording will be available on the Investcentre in the coming days, and the content of this webinar is for a professional advisor audience only. So as I mentioned, the focus of this presentation will be the FCA's recent platforms market study published in July this year. Just in case that didn't make your summer reads for 2018, we thought it would be useful to run through some of the key findings and recommendations from that FCA report. Now, in terms of the things that we're going to focus on in this webinar, there'll be three main bits. So firstly, why is the FCA looking at the platforms market now? Secondly, we'll look at what the FCA found in the two main parts of the platform market, namely the direct-to-consumer part of the market and the advised part of the market. And finally, we'll round off by looking at some of the key issues this could raise for advice businesses and the wider platform market in general, as well as some consumer issues that it throws up as well. So firstly, why is the regulator looking at this market now? Well, as I'm sure you're aware, as this slide shows, the platform market's grown significantly in the UK post-financial crisis. Assets have risen from around 108 billion back in 2008 to almost 600 billion in 2016, and will inevitably be a lot higher than that as we move into 2018 and beyond. There's been a particular spike in the value of assets since 2013, with platform assets doubling over that short period of time, although it's worth noting that not all platforms in the market are matching those rising assets with profits on the bottom line. Clearly, that's partly down to the near 10-year bull run that the stock market has experienced, but it's also partly due to a rapidly growing customer base. As you can see in the final bullet point there, over 2 million more retail platform accounts have been opened between 2013 and 2017, so over a 4-year period. And the key point here, and the key reason why the FCA is looking at the market now, is it's because it has become a central function of UK financial services generally, and the FCA understandably wants to kick the tires to make sure it's working properly and customers are getting a good deal from both the advised bit of the market and the D2C bit of the market as well. So which bits of the platform market has the FCA looked at? Clearly, as I mentioned, this is not a homogenous market. D2C platforms and advice platforms are very different beasts with different features and different pricing structures. And that's mainly because they've been built from a different starting point, one servicing an advisor that's working with a client and one clearly working directly with the end customer. While growth in D2C has been rapid, as you can see here, up to 189 billion in assets, and perhaps garners more headlines than the advised part of the market, the advised part of the market remains dominant. It's more than 50% bigger than in AUA terms than the D2C side of the market. In terms of, so clearly, as I say, this isn't a homogenous market. So slightly frustratingly, the FCA's paper in large parts merges the two parts of the market together in its analysis, a slightly odd approach, which makes, frankly, at times, it makes it quite difficult to figure out which part of the market they're talking about. However, having picked the bones with my colleagues, there are a couple of pretty clear overarching questions that the FCA is asking here. So firstly, it's looking at how is competition developing in the platform market. Is it healthy? And is the demand side of the market strong enough to ensure customers get a good deal? And again, particularly in the D2C side, that's something which we've seen in the retirement outcomes review as well in terms of the FCA's focus. Secondly, and a point that perhaps isn't addressed to the degree that everyone was expecting in the platforms market study, are platforms driving efficiency in other parts of the market through their influence as a key distributor. So in terms of some of the content of the paper, this paper is actually jam-packed with useful consumer research looking at various things. And if you haven't had the time to read through it and look in particular at some of this consumer research, I'd highly recommend that you try to find some time in your diary to review some of the responses, because they are quite interesting. I would say that it has been refreshing to see the FCA make a genuine attempt to assess value for money holistically in the platform market, rather than just focusing solely on things like costs and price, although clearly this is a very important determinant of the value for money that consumers get in the end. In terms of those different bits of information that are in here, I've just picked out one chart that shows the different things that advised customers and direct to consumer customers value when they're choosing a platform. And one particular one to point out, and one where there's a clear difference between advised versus non-advised, is on the importance placed on the charges that are levied. So you can see in the D2C side, so the left-hand side of the screen there, 39% of D2C customers said charges were important initially, so when they first chose a platform, and that dropped slightly to 37% who are now using the platform. On the advised side, much lower figure, so less than a quarter, 24% said charges were important initially, and that drops to just 17% once the platform is being fully used. Also interesting to note that advised customers tend to value being able to monitor and manage their own investments in conjunction with their IFA as well, and we've seen many platforms look to develop propositions in line with that customer expectation. So turning to the headline findings of the report itself, the good news here is that broadly the FCA found the market to be working well for consumers and to be in rude health. Aside from some other things, the fact that lots of platforms are struggling to turn a profit suggests that there is genuine competition in this marketplace, and we aren't seeing consumers being milked by an uncompetitive market. Crucially as well, as I said, this has been a holistic piece of work, and in the surveys that the FCA did, they found that customers are generally pretty happy with what they're getting from their platform and the value for money they're getting from their advisor as well. That said, clearly this is a significant piece of work, and you would be surprised if the FCA didn't find some issues that need to be addressed. So the FCA has raised some concerns that the competition might not be working well for consumers in 5 key areas, and you can see them listed, highlighted on the slide there. Although it's worth noting the issues are different in advised versus non-advised, and we'll try to pick those two parts of the market apart as we run through the presentation. So 5 key parts here: switching between platforms, shopping around, model for portfolio risk labels, investors holding too much cash, a familiar theme from the retirement outcomes review, of course, and an old favourite, the service provided to orphan clients. So we'll look to pick apart the 2 parts of the market separately here. So first of all, looking at the direct to consumer part of the market, while clearly not directly relevant to advisors, I think to understand where the FCA is coming in its platform market risk study, you have to see how it views both direct to consumer offerings and advisor offerings as well. So firstly, let's look at charges in the D2C space. So as I mentioned earlier, while charges are listed as a main priority for D2C customers, fewer than half shop around for their platform before making a decision. So we can see there's a difference there between what people say is important to them and their behaviours in choosing a platform. And clearly that's something that the FCA is potentially concerned about and is considering remedies for. In terms of the remedies that may happen and changes that may come further down the track, once we get a final paper, of course this is only an interim paper at this stage, the remedies focus squarely on improving disclosure and perhaps enabling greater use of reliable comparison tools. So the aim here is very much to strengthen the demand side of the market in relation to D2C platforms and charges. A couple of big issues here, some hurdles that the FCA is going to have to overcome if it wants to go down this route. Firstly, how exactly do you get useful and accurate comparisons with such variations in charging structure? So clearly different platforms, as you see some of the platforms listed there in the top right hand corner of the slide, charge in different ways. You've got some that offer a single charge, some that have menu based charging structures, and as a result you'll have different levels of value for money at different for different size pension pots and different and customers who are aiming to do different things with their money. Now, I think that clearly that variation, that choice is a good thing, but it makes comparison very difficult, and it's why you have a lot of these consultancies offering these pretty heat maps to show people where they would get the best value from their platform. Secondly, and I think arguably more importantly, customers already receive far too much regulatory information, in my opinion. A lot of the stuff that you get when you have a pension, the disclosure requirements are huge, and frankly most people don't read this information anyway. So it would be a concern if the FCA were looking to layer extra materials on top of the stuff that consumers already receive when they don't engage with that stuff anyway. And ideally we want to see the regulator consider a root and branch review of the retirement communications that people receive, with the aim of simplifying where possible and coming up with things that actually work rather than just simply meet regulatory requirements. So on to the next bit, again, another familiar topic, I'm sure, switching and specifically barriers to switching between platforms. In a perfect world, consumers would switch instantly based on perfect information and zero cost. However, as all of you will be aware, for various reasons, the transfer process from one provider to another can be quite painful. Fundamentally, it takes two to tango when you're transferring from one provider to another, and at the moment there are clearly sticking points in the process when you want to move your money from one provider to another, ideally to get better value for money. As the NMG research which accompanied the FCA study showed, customers need significant and sustained platform issues before they do anything. And yes, surprise, surprise, inertia is a big part of this. So the FCA rightly wants to try to smooth this process and has looked at a couple of specific remedies in the D2C space. So firstly, exit fees. So this is one of the few clear proposals in the FCA paper. They've suggested that exit fees should be banned. Clearly, some providers charge exit fees, some providers don't. AJ Bell does, and justifies that because there are extra costs involved when a client looks to transfer, and it's the classic battle really between fairness and simplicity. Clearly, you're going to have cross subsidizing if you remove exit fees, but that's the direction that the FCA appears to want to go down based on its consultation. Secondly, and this is hopefully something that will bring benefit to advisors as well, which we'll talk about later on in the presentation. The FCA is also looking to the industry through the Transfers and Re-Registration Industry Group, or TRIG, to speed up transfer times between platforms. That's a group that's existed since I think 2016, and the hope is that with the FCA putting some pressure on that group to deliver real results, the process of moving from one platform to another will become less onerous than it is today. A couple of other ideas have been floated here as well, including sunlight remedies, so things like requiring firms to publish transfer times, the idea being if they're embarrassed by the length of time it takes to transfer, and more attention is brought to this, perhaps by the media as well, that platforms will be pushed into improving their processes. I think this is broadly the right approach for now, looking to improve the way that the industry works and doing it on a voluntary basis. But it's likely that some in the industry simply won't play ball, and they'll require the hot breath of the regulator on their necks before they start to make any significant improvements. So on to the next part of the D2C bit, one that I've mentioned a couple of times already, the issue of clients holding cash for what's perceived to be lengthy periods of time and potentially missing out on valuable investment returns as a result. If you read the FCA's retirement outcomes review, you can tell I really know how to have a good time, then this will look awfully familiar. Clearly, as I mentioned, the concern here is that DC investors hold cash for an extended period of time and miss out on valuable asset growth over the long term. The main evidence cited here, as you can see in the second bullet point of the slide, is the difference in the amount of cash held by advised customers versus D2C customers. So more than double the assets on DC platforms held in cash versus their advised counterparts. That's as of June 2017. The FCA, I think, is right to recognise the risk here. Clearly, we're moved into an economic environment where inflation is returning to the economy, and if you couple that with a platform charge, and if the cash is earning at or close to 0% returns, then customers are going to be locking into potentially significant negative returns, particularly if they hold cash over the long term. However, the issue with the approach the FCA's taken here and the way that it's analysed the market is it's just taken a snapshot of consumers' holdings of cash. And the thing that needs to be borne in mind here is that D2C customers will hold certain amounts of money in cash for various reasons. For example, they may have some money held to one side to pay charges. Indeed, that would be advisable for D2C customers. Many will be in income drawdown as well, so they might keep 2 or even 3 years of pension in cash, knowing that they're going to need that money to be liquid. And some might actively be choosing, of course, to stay away from stock markets for now and keep their money in the safe haven of cash, even knowing that inflation and charges will eat away at the value of that money, because they fear that markets might be due a downturn, which is a perfectly reasonable thing to do. The risk in looking at the snapshot and taking action based on that is clear that you will end up with inappropriate outcomes, and we hope that the FCA will look at more granular data before it makes any regulatory interventions in this area to assess not only how much money is held in cash by D2C customers, but also the length of time that money is held in cash and the reasons that customers are holding that money in cash as well. So moving on to the next bit that's relevant for the DC part of the market, model portfolios. Again, model portfolio issues mainly pointed out within the non-advised market rather than the advised market. Clearly, where an advisor is involved, there should be a fairly sophisticated risk profiling process involved, which matches the client to an appropriate model portfolio where that is their preferred route. Lots of D2C investors nowadays are using these off-the-peg solutions. The FCA found around 1 in 5 are using them, and as is mentioned in the bullet point there, crucially, the customer profile of these new investors is younger, less experienced, lower appetite for risk, and less confident. So they really need to be confident that the model portfolio they're choosing is doing what it says on the tin and is appropriate for their needs and their risk appetite. In terms of significance of this part of the market, assets have grown massively, so from around 5 billion in 2011 to 38 billion in 2017. So clearly there is a need and a drive for the FCA to make sure that model portfolios in the D2C part of the market in particular are working as they should do. To quote from the FCA's report, the problem that has been identified with model portfolios, similarly labelled model portfolios expose investors to very different underlying assets and volatility in returns. In other words, one man's cautious model portfolio might be another man's adventurous model portfolio, and therefore it's difficult, particularly for direct-to-consumer customers, to compare the different model portfolios that are available from different providers, because the risk labels will often represent different amounts of risk and different underlying assets. In fact, the FCA found that only 17% of the D2C model portfolios it analysed had comparable risk labels. Clearly a problem there that needs to be solved. No specific remedies proposed by the FCA at this stage, but it is clearly a major focus of its work following the publication of this interim report. Part of the problem in this side of the market, again, just in the D2C side, is that providers are generally reluctant to offer self-help risk profiling tools to guide investors for fear of straying into providing advice, which the vast majority of D2C providers, as you're aware, are not willing to do. So whether or not the regulator will look at providing guidance to firms to make it easier for those tools to be provided to help nudge people along into the right solution remains to be seen. We'll see that in the final report when it's eventually published. Now, turning to the advised side of the market, the good news is that by and large, the FCA gave a relatively clean bill of health to the advised part of the platform market. As I mentioned at the start of the presentation, in the main, advised clients are happy with the value of the services they're receiving. However, there are one or two issues that the regulator has raised, which it's probably worth you being aware of as you review your business processes. Firstly, orphan clients. So this will be a familiar issue to many of you, beautifully illustrated here by Oliver Twist. Except in this case, platforms absolutely aren't saying, please, sir, can I have some more? Orphan clients present a significant administrative problem for the platform industry, and clearly also raise concerns for the FCA in ensuring good customer outcomes. Advisor platforms aren't built for direct-to-consumer customers, frankly, and some platforms, again, including AJ Bell, levy an extra charge to cover the extra administrative costs involved in servicing orphan clients, and also to give those clients a nudge to move on to a more appropriate solution for them. Now, the FCA is looking at ways to make it easier to move clients onto a more appropriate offering. At the moment, certainly from an AJ Bell point of view, we place significant time and effort and resource, and I found out about that recently when we had a question in from the Sunday Times around the orphan clients process. There really is significant effort put in to encourage orphans to transfer to a more appropriate direct-to-consumer offering, but clearly for various reasons, a lot of those clients choose not to budge, and as a result there is an increased risk there of them not getting optimal outcomes from their platform. So it's very much, again, a consult and a wait and see what the FCA is going to do in relation to orphan clients, but that will be a key focus, and it's worth reviewing any previous orphan clients you may have had. Now, turning on to switching. This, again, I suspect will be very familiar to a lot of you. We saw earlier the FCA had concerns about the lack of switching in the direct-to-consumer market. The regulator has also raised concerns. The existing framework includes barriers to advisors moving clients to a better value platform. One issue advisors face is that at the moment, switching creates an advice event with, of course, associated costs and time involved in doing it. Bulk switching in particular is difficult as a result, and that's something that the regulator mentioned specifically in the consultation, and we're hoping that the regulator will give some more clarity on how this can be done in a simple, cost-effective, and of course compliant way. It would certainly be desirable if moving large numbers of clients to a better value platform were made simpler, and it certainly feels like it shouldn't be beyond the wit of man. to create a structure where if large numbers of clients are moving, but the underlying investments and the wrapper and all the rest of it are staying the same, but there's a lower charge involved, that should be able to be done in a way that is relatively simple and cost effective. But clearly the danger from the FCA's point of view is that these costs and the difficulties in moving risk creating a status quo bias, hence the rather tenuous link to the picture of status quo in the top right hand corner of that slide. So the next part of the FCA's potential concerns around the advised part of the market, and I've got a couple of slides on this, cover something I actually became fairly knee deep in as a hack when I was back at the advisor publication Money Marketing. Namely, that's the issue of non-monetary benefits, or what's often referred to as inducements. However, I would say that while a few years ago the focus of the FCA's ire was advisors being wined and dined at concerts and sporting events and all the rest of it, it now looks to be looking at seemingly mundane arrangements, and I think that is testimony to how far the industry has come in cleaning up its act in this particular area. So in this part of the consultation, the FCA is asking whether the provision of things like online tools, training, and white labeling either provide any benefit to the end client, and also asking the question, does the provision of that benefit make an advisor think twice about switching to a different provider? So in essence, is there a behavioral bias to stick with your existing advised platform because they offer you all these different nuts and bolts on the side? And is there any client benefit from those nuts and bolts? So sticking to that slide, all the FCA is saying at this stage is that advisors and platforms should review their existing arrangements in light of the COBS rules governing non-monetary benefits. So it's very much a case of check what you're doing, check that you're comfortable with the things that you get from your platform at the moment, and make sure that they fulfill the regulator's requirements. There's no sense here that the regulator is clamping down or looking to go after firms at this stage. However, the FCA has given an indication of what might be acceptable under its rules and what might not be acceptable under its rules, although it's worth bearing in mind we're still at the stage of interpreting the regulator's intentions. So we've got three sections of things here that, and the main one I think to focus on here is Section B. So Section A, the FCA considers most of those things are broadly appropriate and unlikely to distort advisor incentives. So things like charge collection, reporting and management information, CGT calculators, and pre-funding, the regulator doesn't have a particular problem with. Equally, the things mentioned in Part C, so asset allocation, fund risk profilers, cash flow modelling, retirement modelling, and research and best buy lists tend to not be too prevalent in the market. So it's very much Part B where the regulator is focusing. Although it's worth, as I said, it's worth remembering there's been no specific intervention at this stage. However, so if we look at the things that are in Part B, CPD, continuing professional development, we've also got white labelling services, which are part of the regulator's focus. Again, we're not clear exactly what they are and aren't going to allow at this stage. Also, model portfolio and book rebalancing and switching services. So as you'll be aware, some platforms offer things like model portfolio management and rebalancing, which are intended to make processes more efficient. The FCA's question here is, does the client benefit through the lower charges that should, in theory, be generated from those efficiencies? There's also a second underlying concern there. The FCA is worried that where a centralized investment proposition, commonly referred to, of course, as a CIP, is established, it becomes more problematic to switch in a client's best interest because that becomes embedded into the advisor's process. While some of this might sound like it's something to be particularly worried about at this stage, I'd suggest it isn't right now. The FCA isn't coming down with a giant regulatory hammer on advisors on these kind of things, but it is worth, as I mentioned at the start, reflecting on your own arrangements to make sure you're comfortable they remain compliant with the FCA's rules. Now, I always like to insert a slide containing one more thing in homage to Columbo, the greatest detective of all time. One of the things from the platform study set out to consider was whether platforms are holding fund managers' feet to the fire. Clearly, they have platforms in theory should have a privileged position in the market where they can really push fund managers to reduce their costs and create good consumer outcomes at the end of that process. There is a question about whether or not this is really happening. We've seen extra complexity and barriers to switching for some through the provision of cheaper super clean share classes, but clearly these aren't universally available to customers. Furthermore, being unable to get super clean elsewhere is an obvious barrier to switching from a provider that does have access to those super clean share classes that are offered, of course, based on fund flows. The key problem, which hasn't really been addressed at all in the FCA's platforms market study, is that without a mechanism to negotiate with fund managers, because of course cash rebates were banned by the regulator as part of the retail distribution review, how exactly can platforms secure a better deal on behalf of customers? That remains an open question, and I'm sure many providers, including AJ Bell, will be pushing the regulator to give an answer as to how they can better hold fund managers' feet to the fire and push them to reduce their charges. Industry reaction, so clearly that's always important in terms of framing where the regulator is going to go and any strengthening there might be of the initial set of proposals that we've just run through there. Generally, people have been quite positive. I think this has been a reflective piece of work by the FCA. There's no sense that they're jumping in with 2 feet and looking to make interventions for interventions' sake. As my boss Andy Bell points out, in the end there, while no industry is perfect, most of us felt a few steely glares from the regulator and maybe a yellow card or two would do the trick in terms of platforms market review. That's exactly what the FCA, to its credit, has chosen to do. So it's seen a market that is broadly working well with a couple of issues and has gone to the industry and said, these are the issues, we want you to look to address them yourselves, but we're not going to come in with a big regulatory mallet and force you down one route or another when the market is generally delivering good outcomes for consumers. So just to sum up those slides, so key issues and takeaways for advisors. The FCA is obviously, when we look at this in conjunction with the retirement outcomes review, squarely focused on delivering value for money for consumers, both from the platform market and from the retirement market in general. The good news is that the FCA is looking at that holistically. So it is about price, but it's also about the services that are delivered to end customers as well. Interesting to note, the regulator uses revenue earned per pound of assets under administration as a proxy for the value for money that is being delivered by different platforms, and it's likely that that figure will become a key number for advisors when doing their due diligence on their platform choice, and indeed for direct to consumer customers as well when they're assessing whether they're getting a good deal. So it's worth being familiar with those figures. There are large variations across the sector, so I think you go from somewhere around 22 basis points up to 54 basis points, and so clearly there are differences in the prices being charged and the amount of money being made by different platforms. So it's worth reviewing your existing arrangements, not only in relation to that value for money, that pounds of assets, that revenue earned in relation to pounds of assets under administration figure, but also your existing arrangements in relation to COBs to make sure that you are comfortable that these are compliant with the FCA's rules. But remember that this is only an interim report, and so as such is subject to change either in a positive direction or indeed in a negative direction. That's it from me. Thank you very much for listening in. As we mentioned at the start, if you have any questions, then fill them in the box on the right hand side, and any responses will be emailed to you subsequently. Thank you very much for listening, and I look forward to speaking to you soon. Take care.